If your paycheck, your pension, or your benefits arrive by direct deposit, 3 rules are already active right now that quietly decide how much of that money you actually get to keep. Most people receiving direct deposits have no idea any of this is happening, and the reason nobody explained it to you is the same reason it keeps costing people money. These are not future risks. They are already being applied to accounts exactly like yours today. Here's why any of this is changing in the first place. Because the context matters. Direct deposit was built around simplicity. Your employer or the government sends the money electronically. It lands in your account, and you use it. That was the model for decades. 2 things broke that simplicity. First, fintech apps began advancing paychecks early, sometimes by a full day or 2, competing directly with traditional banks on speed. That competition exposed a gap that already existed. Many banks have been placing holds on direct deposits for 1 to 5 business days, sometimes longer, without giving the account holder clear notice. People discovered that gap the hard way, through overdraft fees on money they believed had already cleared. Second, direct deposit fraud increased. Criminals began targeting payroll systems and HR portals, altering routing and account numbers, and redirecting paychecks into accounts the employee never opened. That fraud volume triggered regulatory attention at the federal level, resulting in 3 separate rule updates touching 3 different parts of the direct deposit process. They didn't come from the same agency, they didn't take effect on the same date, and none of them were communicated in a way an average account holder would ever encounter. That's the actual problem. Nobody tells you these rules exist unless you happen to be sitting across from someone who's Here's the relevance for 2 different groups before we go further. If you're living paycheck to paycheck, these rules affect you most immediately because a single hold can snowball into overdraft fees, return payments, and a damaged banking relationship. If you're financially comfortable, you're not exempt. The offset rule carries no income threshold, and payroll fraud doesn't check your account balance before it strikes. Under the Expedited Funds Availability Act, banks have been required 4 years to make direct deposit funds available within specific timeframes. The enforcement gap was this: banks were placing holds, often citing exceptions the law technically permits, without giving account holders adequate written notice. Regulation CC, under Title 12 of the Code of Federal Regulations, requires that when a bank places a hold longer than standard next business day availability, it must give written notice, not a verbal explanation at the counter, but something in writing at the time the hold is placed, stating the reason and the exact date funds become available. That requirement now carries real consequences in 2 ways. Banks that hold the electronic payroll deposits without proper written notice face examination findings and civil penalties through the Consumer Financial Protection Bureau. And more directly for you, if your bank held your deposit without proper written notice and you were charged overdraft fees during that window, you have standing to request a refund of those fees. Your bank will not volunteer this. No form is mailed to you automatically. You have to ask. Most account holders assume the bank can hold funds for as long as it wants. That assumption is wrong, and the bank knows it's wrong. Picture a 49-year-old warehouse coordinator in Fresno, California, whose bi-weekly paycheck lands every other Friday. His bank placed a 3-day hold citing a security review. Despite an 8-year account history, no written notice arrived. To subscription payments and 1 loan installment bounced that weekend, 3 overdraft fees, 1 return payment fee, $140 total, for money that was already legally his. If you live paycheck to paycheck, the protection is direct. Any hold placed without written notice is a procedural violation, challenge in writing to recover those fees. If you're more financially comfortable, your exposure is smaller, but not absent. Large one-time deposits, like bonuses or settlement payments, can still trigger unexpected holds. One more detail: Regulation CC separates reasonable cause holds from standard holds. A reasonable cause hold requires the bank to document a reason specific to your account, not a blanket policy applied to every account of a certain type. If your bank can't produce a specific reason when you ask, that's worth escalating directly to the CFPB. What to do? Contact your bank in writing, not by phone, and request your account's current hold policy for direct deposits. Ask specifically what regulations CC requires for your account type and what exceptions your bank is authorized to apply. Keep the response. It becomes your documented baseline if a future hold produces fees you want to dispute. The fraud pattern grew serious enough that NACHA, which governs the OC network processing nearly all US direct deposits, updated its rules to place greater accountability on payroll processors and their clients. The change requires financial institutions and payroll processors to validate an account before a direct deposit entry is sent, confirming the routing and account number actually belong to the intended recipient before releasing funds. In practice, that means two things. First, employers and payroll processors carry more responsibility when fraud occurs through an unvalidated routing change. Second, every ACH direct deposit now carries a trace number, a unique identifier that follows the transaction end-to-end through the processing chain. That trace number is available to you on request. Almost nobody asks for it. Almost no HR department mentions it, but it's attached to every paycheck that has ever landed in your account by direct deposit, and it's the single most useful piece of documentation for resolving a misdirected or stolen paycheck quickly. The mistake that costs people weeks: when a paycheck is misdirected, most employees contact HR first. HR contacts the payroll processor. The processor opens an internal ticket, and weeks pass. The faster path is contacting HR and your bank's ACH dispute department at the same time, giving them the expected deposit amount, the expected settlement date, and a request to trace that specific transaction. With the trace number, your bank can go directly to the receiving institution through the ACH return process. Without it, the process stalls. If you're living paycheck to paycheck, a misdirected deposit isn't a minor inconvenience. It's a real financial emergency, and knowing the trace number process means you don't have to wait on your employer's internal bureaucracy. If you're more financially comfortable, your bigger risk is fraud. Redirection scams increasingly target higher balance accounts, since the payoff is larger and those accounts are checked less frequently. Pull up your most recent direct deposit. Note the exact settlement date and amount. Contact payroll or HR and request the ACH trace number for that specific deposit. Most major payroll platforms can retrieve it within 24 hours, and some show it directly in the employee portal. One additional note: NACHA also expanded same-day processing windows, so if your paycheck has been arriving faster lately, that's the reason, and it also shrinks the window during which a hold can even be applied. The Treasury Offset Program, run by the Bureau of the Fiscal Service inside the US Treasury, is how the federal government collects delinquent debts by intercepting payments it makes to you. It already captured tax refunds, Social Security payments, federal wages, and federal contractor payments. What's changed is the scope of debts now qualifying for referral, and the speed at which offset occurs once a debt is referred. More states have expanded participation, sending additional categories of debt, municipal court fines, state benefit overpayments, past due child support, into the federal system, even in states that weren't previously active. Once a debt is referred, the offset is automatic. No lawsuit, no court order. Funds are intercepted before they reach you, or immediately on arrival. If you receive Social Security, know this number: under 31 USC Section 3716, your benefit is protected up to a floor of $750 a month. Anything above that is exposed to offset for qualifying debts. That floor is fixed. It hasn't adjusted for inflation, so it protects less every year prices rise. For federal wages, the offset follows the same disposable income formula used in standard wage garnishment: 15% of disposable pay per period, or the amount by which pay exceeds 30 times the federal minimum wage, whichever is less. Tax refunds run through the same system, and refunds carry no fraud protection. A qualifying debt can absorb an entire refund in a single pass. The part that surprises people who believe they're debt-free: a referral made years ago can remain active in the system long after someone believes it was resolved. An informal payment plan, a loan someone thought was discharged, an old benefit overpayment, all of it can sit in the database indefinitely and trigger an offset with no fresh notice. Consider a 61-year-old retired school custodian in Akron, Ohio, drawing a modest pension alongside Social Security. 3 years ago, she entered an informal repayment plan with her state's revenue department over a small tax balance. She made payments for 7 months, believed the debt was cleared, and stopped. It wasn't. The balance had already been referred to the federal offset program before her payments even began, and the referral was never withdrawn. Her next pension deposit arrived, $295 short, with no advance notice beyond a letter that showed up 3 days after the offset had already occurred. If you're a lower-income Social Security recipient, the $750 floor exists to protect you, and any offset that pushes your payment below it can be challenged. If you're a federal employee, a pensioner with higher income, your exposure scales with your pay, since the 15% calculation pulls a larger dollar amount from a larger paycheck. The mistake that makes it worse: calling the creditor agency first. That call almost never resolves an active offset, because the offset was executed by the Bureau of the Fiscal Service, not the creditor. Only a formal dispute or referral withdrawal filed through the Bureau of the Fiscal Service stops it. Check the database, go to fiscal.treasury.gov and find the Treasury Offset Program section, or call 1-800-304-3107 with your Social Security number to find out whether a debt has been referred and by whom. Do this before your next expected deposit. Request your pre-offset notice under 31 U.S.C. Section 3716. The referring agency must send notice before referral, including the debt amount and your right to dispute it. If you are offset without ever receiving one, that's a procedural defect. Request documentation in writing. File a formal dispute if the debt is incorrect or already resolved. Ask the agency to confirm in writing and submit a referral withdrawal to the Bureau of the Fiscal Service. Confirm your floor if you're on Social Security. If your payment drops below $750, call the SSA Offset Coordinator at 1-800-772-1213 and cite 31 U.S.C. Section 3716 directly. Consider a secondary account, opened as single owner, to create practical separation during a dispute period. It won't eliminate federal offset exposure, but it can limit collateral damage from bankside holds. Document everything: statements, trace numbers, hold notices, correspondence, in one folder going forward. One small habit that makes all of this easier: turn on real-time deposit alerts in your banking app. Most banks offer this free, and almost nobody activates it. Without it, you might not notice a short deposit until days later, trying to reconstruct what happened from memory. The connecting principle across all three is simple: your bank, your payroll processor, and the federal offset program, each operating under specific legal obligations to you. Your bank has to notify you of holds in writing. Your payroll processor has to give you a trace number on request. The Bureau of the Fiscal Service has to confirm the referring agency notified you before an offset. None of those obligations enforce themselves. Every one of them requires you to ask, to document, and sometimes to push back formally in writing. Knowing the written notice requirement exists, knowing how to request a trace number, and knowing the offset dispute line puts you in a genuinely different position than you were a few minutes ago. That's the difference between paying fees you never owed and keeping that money. It's the difference between watching a deposit shrink and challenging the referral before your next payday. One question that comes up constantly: does closing an account and opening a new one somewhere else resolve any of this? No. Hold exceptions are often tied to how new an account relationship is with a specific bank. So switching banks can actually trigger a fresh new account hold rather than avoiding one. And offsets are tied to your social security number and the underlying debt, not to any particular account. Moving banks doesn't remove you from the federal database. The only thing that actually resolves any of this is working the dispute process directly, using the specific citations and contact points covered here. Specific job is to explain them.